Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, listener, and thank you for joining me today. Another incredible week for markets, obviously a little bit better for investors. So equity markets up over 5% from the trough that we saw on Tuesday. Bond yields are going higher, so that's not so good news for bond investors. But maybe Manpreet, let's got with me, Manpreet Gill, who runs our fixed income currencies and commodities division. But maybe we'll start, Manpreet, with China, because that is obviously the most volatile area. We saw a bounce of around 15% in the latter part of the week after a 10% decline earlier in the week. So it's been a very volatile. So just get a sense, obviously policymakers have been making some comments. Do you think we've just had a whatever it takes moment? And do you think that the recent rebound is sustainable?
Hi, Steve. Well, it certainly is tempting to interpret it like that. We've had, as I said before, a couple of eye-watering declines in Chinese and Hong Kong equity markets, and then we got a flurry of statements thereafter. But I think a few things stood out from the policy statements. I think first is, Chinese policymakers said they'd actively release policies that are supportive for the market. They also said they'd coordinate any future regulation with financial management regulators. And we also had media reports that suggested there might even be a possibility of achieving a deal with the US regarding some of the US-listed Chinese ADRs. Now, arguably, these statements, together with what's turning out to be an aggressive growth outlook and some pretty oversold conditions in Hong Kong and China equities, do brighten the outlook for Hong Kong and China equities to some degree. However, these high expectations, whether it's a whatever it takes moment, does mean that markets are now likely to focus on the nature of delivery of actual policy pronouncements. So I think that's going to be key in the coming weeks and months. I think when it comes to the outlook for Hong Kong and China's equities, I think from a long-term perspective, we are still positive. And we think a lot of these measures should feed through into equity market returns. But I think in the near term, markets are likely to look for that evidence. So from a risk-reward perspective, that long-only exposure is one route, of course, to taking that. But, another opportunity might actually sit in the high volatility itself. I mean, if you look at the volatility on the Hang Seng Index, for example, that's at the highest it's been in almost 10 years, if you exclude sort of the brief COVID spike. So selling that volatility to generate income is another way we think to navigate the near-term sort of market environment. You do give up some of the potential upside should we end up getting a strong rally, but in return, this sort of strategy does offer you at least some downside protection if the period of volatility is not completely over. So that's the way we'd sort of prefer to navigate the near-term environment.
Yeah, so I guess, China has been center actually of the bond market space as well, right? So we've seen the Asian high yield bonds, which is, at the end of the day, a lot of it is China high yield property bonds. So they've been beaten up quite badly over the course of the past 6 months as well. And that's, had accelerated earlier this year. Does the same logic you apply to the Chinese equity market apply to the property sector bonds?
Well, to a degree, yes. I think some of the policy comments do offer room for optimism on the bond market as well. I think what's key is some of those comments show that policymakers do appreciate the extent of the stress the property sector is facing. But I think what's different here is that for the China high yield property sector, its liquidity, that in our view remains the key pressure point. And that pressure, of course, in turn originates from what's turning out to be a prolonged cash collection cycle, on obviously weaker demand outlook, a lack of adequate access to refinancing channels, which we think is particularly key. And all of this, of course, coming when there's a ramping up of short-term liabilities. So you're right that the sector is absolutely looking quite beaten up. I mean, if you look at sort of the China high yield index, for example, more than half of the bonds in that index are trading at prices of 60 cents on the dollar or lower. So those kind of returns usually point to pretty attractive returns on a 6 to 12 month horizon. But I think the key from policy measures will be the comments are positive, but I think we need to see actual measures to address some of those liquidity pressures to help avoid further waves of debt restructuring.
Yeah, I guess that the experience over the last few months shows that it's not necessarily for the faint-hearted. So we think it's a great opportunity, but it's certainly going to be a volatile road and not a straight line path. Okay, let's move to the US, so obviously we saw the FOMC, so we saw the first rate hike of the cycle coming through from the Fed, and they sort of indicated that we're going to see 7 rate hikes this year, or that's at least their center of expectation at the moment. And we saw changes to their economic forecasts. So can you give us a sense of what you make of the Fed meeting and also its implications for equity markets?
Sure. And I think when you look at the Fed decision itself, I think from a market perspective, there are 2 things in particular that stand out. One is that when you think about the rate projection of 2022, yes, there's 7 rate hikes at a median, but arguably that's already in the price when you look at market expectations. So that's one factor. And second is when you think about the growth downgrade, I think that's one factor people have pointed out as a concern. But even the downgraded GDP growth forecast is still well above the long-term GDP growth trend for the US, which sits just below 2% in our view. So that, and you put those 2 factors together, our takeaway is that the Fed decision doesn't really put policy, in the way of risky assets like equities, not this year at least. The context here is that over the long term, through many cycles, we know equities can be volatile in the 2-3 months before and after the first Fed rate hike. And we've seen that already in this cycle to some extent, but they do revert to their long-term trend thereafter. The other factor is that if we see 7 rate hikes this year, it means the upper bound of the Fed rate would reach 2% by the end of 2022. But given inflation forecast, that would still leave real rates negative. So had the Fed policy rate below where inflation is. So that means policy, of course, will come off zero, but we think that policy will still be quite accommodative given the nature of growth and inflation. And finally, more from a shorter term perspective, after the Fed decision, we did get a bit of an equity rebound, and that helped the S&P stay above key technical support, which we think is actually, even from a shorter term perspective, a positive. So yes, there are some longer term questions which you may have to address, maybe in 2023 or later. But at least when you look at this year, the positives in our view seem to dominate, and a policy that is rising off ultra accommodative levels, but is still accommodative. That was what we expected in our Outlook 2022, and that seems to be what we're getting. We would keep an eye on several indicators of stress. One of my favorites, of course, is still the yield curve, but these indicators are not flashing warning signs, for now at least. So we'll be positive unless one of those indicators really turns.
Yeah, I think it's also difficult when we're looking at this week's performance of equity markets to sort of decipher to what extent the Fed helped support the equity market, because it was a hawkish statement which would normally not be supportive, and what's going on in Russia, Ukraine. So obviously we saw Russia and Ukraine talks progressing. The US is obviously pouring water on the idea of anything happening in the near future, but I think maybe people getting a little less concerned about this escalating further. So I think that might have helped sentiment, at least in the short term this week. Maybe finally, let's just talk about gold. I mean, if we rewind to when we released our 2022 outlook, the one real non-consensus view that we had was that gold would rally. And that's obviously one of the calls that's worked out for us this year. Maybe the drivers have been slightly different. It's not like we thought geopolitical risk was going to be a major driver. But maybe looking forward, from here, we've obviously seen a rally. We've seen it test the 2020 high and retrace a little bit. So what's the outlook from where we are today?
Well, I think there are 2 sort of key learnings here. I think one is that gold has certainly proven itself as a hedge against market volatility, particularly one that's driven by geopolitics. But we also learned that short-term driver can ebb and flow together with the headlines. And I think we need to obviously match that up against some of the long-term drivers. Now, I think in terms of long-term drivers, the Fed, as we said, is projecting 7 rate hikes this year and most probably 3 in 2023. But we actually think that is unlikely to be a big headwind for gold, given that seems to be, priced in by markets to a large extent. So that should, not be a hurdle. And if anything, if we get pockets of volatility along the way, gold could help lean against that. The other factor, that could potentially drive gold is the US dollar. And a weaker dollar, if you recall, is positive for gold in our view. And it's interesting that, yes, we've got a bit of a spike in the dollar recently, but in the bigger picture, the dollar really hasn't rallied in a big way or a consistent way across most currencies. So we view the US dollar trend as a little bit more neutral for now. And of course, we expect eventual turn lower in the US dollar. So we think that factor, if anything, could end up being supportive for gold in the long term. And the final point is that, just looking through the Ukraine crisis specifically, the nature of recent sanctions have once again raised questions about what constitutes an appropriate safe haven or a reserve asset, whether you're looking from an individual or a sovereign perspective. So we could see that factor, of course, supporting physical demand. Now, that's the long-term factors. If you look at the short term, given we've got a bit of a pullback from the rally, we think this pullback is forming a technical bottom, with 1875 in particular turning out to be a key support. So as long as that holds, we do think a bottoming process could occur, and we'd expect a rally that once again tests a 2000 level, a break of which, of course, could lead us right back to 2070 levels.
Okay. Well, thanks, Manpreet. It's a pleasure speaking to you as always. And thank you, listener, for joining us today. As always, if you like what you've heard, please feel free to review and subscribe to our Money Insights podcast channel, which is obviously available on Google, Apple, and Spotify podcast channels. You can also view our content, a lot of our content, on LinkedIn Wealth Insights page. Obviously, that includes some of our publications, blogs, opinion editorials, and TV and radio interviews. With that, I will sign off. Thanks again, Manpreet. Please take care, stay safe, and until next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.